what we did is we compared the CBC data with consolidated annual accounts and with the corporate income tax returns filed in the Netherlands. And what we found were a few reasons why this ETR was so low. I think the first one, and that's a really important one, was the inclusion of participation results. So just to give you two examples, they're stated here on the right on the slide. This is from the annual accounts of two large Dutch multinationals. One multinational reported a commercial profit of 5.2 billion from the sale of a shareholding. So that's an entire division which was sold. That income is exempt under the participation exemption. So what you're seeing is a large commercial profit, but no tax paid or tax accrued because it's exempt profit. Well, most countries have an exemption system or a credit system. So this would be, this is not typical for the Netherlands. This would be the same for other countries as well. Now, the second example is from another large Dutch multinational. They report 3.2 billion in commercial profit, which was exempt. Now, if you correct for that, the ETR in the Netherlands was not 10%, but it should have been 16%. So that's a big difference. And the second thing we found was that CBC reports do not take into account loss carry forwards. So for instance, if you have a loss in year 0 and you have a profit in the next year, you see a commercial profit in that second year, but you don't see any taxes paid for the simple reason that you have loss carry forwards. If you correct for that, the ETR would increase to 21%. So again, that's a big difference. Now, I think there's still a difference between the statutory rate of 25% in the Netherlands and the 21% we have. I think that difference can be explained by reasons of, let's say, the patent box, certain preferential regimes, but also interest deductibility. You should correct for that, but that's, well, minor compared to loss carry forwards and participation results. Another thing we regularly encountered when analyzing CBC data, which I think is also really important, is that we're looking from the perspective of an accountant. And what we often see is accountants, they have a more legal view of profit than what we have. We have a more economic approach. And that's in line with the OECD transfer pricing guidelines. So if you look at annual accounts, you often see billions of profits being reported in tax havens without any personnel. From a Dutch perspective, we would never accept such profits because profits need to be in line with your functionality. So I think that's also important to take into account the CBC information. Having said that, are we alone? No, this is also something which is mentioned by the UK, by Italy, and this is also published on the OECD corporate tax statistics website, so you can see for yourself. And they see the same thing, dividends being included and other participation results being included, which could have a very large impact on the ETR. Another example, by the way, is also the Dutch pension funds. We have large pension funds. They are exempt from tax for very good reasons. I don't want to go into the policy reasons for a pension fund, but they are not taxed on income they receive. So that also lowers the ETR. Just to give you a third example, this is what the US is publishing on CBC data. It's on their website. I've included the link here. And this is information on US multinationals. US multinationals are reporting their biggest profits in the UK, the Netherlands, Ireland, Luxembourg, and Switzerland. And then at a substantial distance comes the largest economy in Europe, which is Germany, with 20 billion in profits. Now, that's interesting because everybody knows that the US doesn't have substantial factories in Luxembourg. Their factories are in Germany, France, and those countries. So again, this is the effect of participation results being included in the CBC reports of multinationals. So it distorts the effect. I think from a risk analysis perspective, that results in a lot of false positives. So we are not happy with that. from a policy perspective, our policymakers are not happy because it also distorts their analysis. I think for NGOs, it's perhaps a little bit different, because what I have seen in many of the reports is that they are selective in the data they choose. They only select data if it's profitable. So for the report I just mentioned a few slides ago, they only look at profits being generated in a specific countries and not to loss-making years. So in this specific case, I looked at individual M&Es because I have access to that data as a tax inspector. And what you see indeed is that some of these US multinationals report 1 billion in losses in 1 year and 1 billion in profit in the next year in the Netherlands, even though their tax profit is, let's say, 50 million a year. They only have 100 of employees working in the Netherlands. So they do have substance, but it's not a very big operation. And those results are from revaluations of participations. And by excluding the loss-making year, NGOs are only looking at the revaluation in resulting in a profit. So in that specific year, you have a big commercial revaluation, but no taxable income because there is no income generated. It's commercial profit. I think that's really important. Okay, let's go to the next slide. That issue is on the agenda of the OECD. Not only because we put it on the agenda, we were really advocating that as the Netherlands, because it's not good for policy reasons, not good for risk analysis purposes. It's incorrect, basically. So in Pillar 1, Pillar 2 blueprints, there is an exclusion of participation results. Now, we are really happy with that, but we would also like the OECD CBC data to be aligned with Pillar 1, Pillar 2. Now, that's a difficult discussion because we need to have consensus with all countries participating within the OECD for that. So I'm really happy that in the last draft, which is hopefully also one of the final drafts of the OECD 2020 review, there is a placeholder for future guidance to exclude other participation results from CBC data. Still, also for that guidance, we need consensus. So we made progress, but we're not yet there. I think that's the biggest conclusion. But I think this is really pivotal for CBC. Yeah, some of the other data issues, I don't want to go into too much detail, but for CBC purposes, you can use different data sources that can lead to changes. What's also important, I think, also for NGOs is that you're missing a lot of information on functionality. So you do have information on tangible assets and employees, but you don't have information on intangibles. You also don't have information on other functionality. So what kind of employees are there? Where are the risks located within the firm, and who has control of the risks? That's a really important element for transfer pricing people to ascertain where value is created. I think what's also missing is data on deductible costs. So not only interest or royalties being paid, but also a deductible cost for the cost of goods sold, for instance. So you see income, but you don't see costs. Then we have a few issues with the data itself. Now, again, I don't want to go into too much detail, but feel free to ask whatever you want. In November 2019, the OECD published a list of the most common errors. These include multiples. In some cases, taxes paid or accrued are included as a negative amount. So then you see some M&Es include taxes paid as positive, some as a negative. You don't want that from a risk analysis perspective or from a policy perspective, but also as an NGO, if you're doing data crunching, the data needs to be consistent, because otherwise you will have very strange results. Another one, I personally always like negative revenues, negative employees. Interesting to see how you can report negative negative employees in a country. I'm not sure what that means, but yeah, you cannot have -1 FTE, I think. But So what we do for risk analysis purposes is we cleanse a lot of that data. So we do queries on multiples. So that's, for instance, if the numbers are being reported in thousands or millions, you will have big outliers, and that will have a big effect on your analysis. We also do a number of other cleansing of the data. But again, that's only for risk analysis purposes. There's a graph on the bottom, and that's indicating the number of tax identification numbers. And tax identification numbers are really important for countries because they use that to couple the data from CBC reports to other sources of internal data. As you can see, the number of TINs has increased substantially. So in the last year, we only had, I think it was, what was it? Well, just a couple of percent in which we did not have a tax identification number. So that's also really important. Then perhaps I'm not sure whether everybody is interested in what we do with the data. I think for us, it's really important because what we do with the reports is we use SaaS software to analyze the reports. We make nice visualizations that's available for all transfer pricing auditors within the Dutch tax administration. It shows information on key risks. So we have different ratios, but we also have risk factors. So for instance, if you have an M&E which is operating in a lot of tax havens or which has mobile activities in low tax jurisdiction, that's all indicated here. So we basically combine different elements of the data in CBC reports to indicate what case handlers should be looking at. And that's also used in the discussions we're having with M&Es. For the largest Dutch M&Es, we will always discuss the CBC report. We do that based on the CBC report, but we also combine it with the tax return. We look at the corporate website. We look at a lot of other internal and external data sources to give a holistic view of how that M&E is operating. And that's also, that also leads to interesting discussions. Fortunately for Dutch M&Es, we have individual case handlers. So there are not too many surprises in 99% of the cases. So I think that's really, really interesting. What we also do is year-by-year comparison. So if there are large deviations, both in absolute thresholds or relative thresholds, that's indicated in red or green. That can be changes in employees. So for instance, if there's a large business restructuring, but also if entities are being liquidated, that will show up in the CBC report. On request, we also do comparative data for specific groups. So for instance, insurance sector, energy sector, we compare those. To be quite honest, I would have expected that to be more successful, but in practice, you see that there's a large, it's difficult to compare data because a lot of these M&Es who work in the same sector are really differently structured. Some are more international, some have large footprint in the Netherlands, and there can also be different reasons for changes in the data. For instance, mergers, acquisitions, they all distort the figures. So that makes it difficult to compare this data. However, it's still interesting to see, for instance, that one company is much more profitable per employee than others. So that could be an indication for us to see why that is. So that's really interesting. I think what's also really important to note is that if you look at what other countries are doing, and I don't want to be too negative about it, but if you look at the recent report from the European Court of Auditors, they audited 5 countries amongst with the Netherlands on 5 of the directives on international exchange. Basically, they said none of the countries is using DAC 3 information, so that's the exchange of ruling. For DAC 4, that's the CBC report, they said, nobody is using it or very little. Without one country, well, you can guess which country that was. That's, of course, the Netherlands. We have quite a rigorous risk analysis system. But what makes it really difficult is that because so little countries are using the data for whatever reason, if you are discussing changes to CBC data, both within the EU, but also within the OECD, it's difficult to reach consensus because you're only aware of flaws in the data or omissions once you start using that data. So that doesn't help. So one of the things we did as the Netherlands was suggest to the European Commission. I think the European Commission has a role there. They should be how should I say it? They should be emphasizing, they should do more to cooperate countries, to liaise and bring countries together to share experience. They should, for instance, build a risk analysis tool similarly to what the OECD did, which is being offered free of charge to countries who want to use that data. And I think it was really important that with any directive, there should be more evaluation points built in after a couple of years to evaluate how the data works. And currently, I think at least for the last couple of years, the European Commission has been putting out these directives very quickly. There's a lot of work being put in that, but after that, it's a done deal, basically. I think the European Commission is realizing that, but they have staffing issues. The OECD has a much bigger secretariat compared to the European Commission. So I don't have a solution for that, but I think that's really something which should be picked up by the European Commission. Let me see. Oh, I can't. I need to. Sorry, I was. My slides went blank, so I needed to start up. I was talking too long on one slide, probably. So yeah, having said that, so I started this presentation with, is it all bad? Is it all negative? Well, no, not really. I think with all the issues, tax transparency has greatly increased awareness for tax for all stakeholders. I see that both in the CBC report, but also if I talk to advisors, if I talk to M&Es, well, even some of the NGOs. For instance, when Shell published its CBC report on a voluntary basis, there were positive reactions by many of the NGOs. I know a lot of the M&Es and their tax advisors, they don't want their companies to have entities in tax havens anymore. I think that's great. There's also better data, so exclusion participation results in Pillar 1 and Pillar 2, and hopefully also in the OECD CBC reporting standard. That would be really welcome. I think the European Commission, the CSRD proposal, is a really important one because it advocates convergence. Together with IFRS, they have a really strong base and a lot of political power. I think you are seeing some convergence in some of the standards. Then there's the database issue. I think that's definitely not resolved. I hope that Ilko will be talking about the GRI database in more detail tomorrow. But I think it's really important to have machine-readable data. And the OECD has it in their corporate tax statistic database, but I think it should be much more pronounced also for some of the other tax standards. I think what the OECD is doing is really important. So providing a free of charge CBC risk tool so countries don't have to build it. It's not only because the OECD started building that for developing countries, but I think a lot of the developed countries were also waiting on that tool because they don't want to put money, effort in a tool which is being offered by the OECD free of charge. And I think the last two bullets were, we are also helping other countries on what to do with CBC data, where the flaws are, what to look out for, what you can do with the data under the EU Technical Assistance Program. We're also involved in the OECD Tax Inspectors Without Borders. But I think my key point is, and that's a negative one to end. I don't want to end with a negative one, actually, but I think, in my view, a lot of the directives, at least, once they are concluded, it's difficult to reach consensus internationally or within the EU to make changes to it. And that's an issue, which I don't have a solution. So before anyone asks a question, I think the only solution is that NGOs keep pointing out the flaws. And we as a tax administration will do the same, but it's ultimately up to our political negotiators to reach consensus on that. So, yeah. Okay, I think that was what I was intending to tell, and I think I am perfectly on time, correct?
Perfectly on time. Thank you, Willem Jan. So we have some questions already in the chat. If you please feel free to also ask more questions after raise your hand, and we try to give you the floor. The first question we have from Cassandra Bett. Could you elaborate on the difference between a legal and an economic perspective on profit? Why will the misalignment between reported profits and real activities not be a problem from a legal perspective? Should I ask each question and then of two questions and then after you reply? What would you like to do?
Let's do one question at a time, I think, because otherwise I forgot what the first question was. I'm not sure how many questions you have lined up, but
great.
Yeah, and Cassandra, please feel free to interrupt if I misunderstood your question. But I think when I was referring to the difference between a legal perspective and an economic perspective, is that if you look at the OECD transfer pricing guidelines, we're looking at functionality. So who has control of the risks? Where are the people located managing those risks? Where's the financial capacity? And you look at the actual functionality for to determine where profit is generated, in which country profit is generated. Accountants look at profit more from a legal perspective. So just to give you an example, what we often see is I saw one yesterday reporting more than 2 billion in profits in a small island with 0 employees. An accountant looks at the contracts and it says, yeah, well, there's an intangible being located at that specific tax haven. That intangible is generating more than 2 billion in profits. So in the annual accounts, I report 2 billion in profits in tax haven X, Y, or Z. From a TP perspective, I would say no, that intangible is not located in that tax jurisdiction for the simple reason that the functionality is not there. So the OECD looks at the DEMPI functions. So who is developing and enhancing that intangible? That's not in that tax haven because there's no one doing the work there. So from a transfer pricing perspective, I would look at whoever is performing the DEMPI functions, and that's, in my view, where that intangible is located and where profit is generated. And if that's the Netherlands, we would correct the profit in the Netherlands and we would report that 2 billion in the Netherlands. In practice, a lot of these structures are, well, I will not mention specific countries, but a lot of these structures are set up by multinationals which are not Dutch multinationals. So that functionality in practice is in 99% of the times not in the Netherlands, but it's usually in some other large country in the world. So in our view, that other country should be taxing those profits. Does that answer your question,
Cassandra?
Yes, thank you. That is very clear. Thank you for that.
So we will go to the second question from Marlene Parker, who is working at the tax administration in Jamaica, and she's asking you the question that I think is important from a developing country perspective. Do you think that the country-by-country reporting has been an effective minimum standard in addressing base erosion?
Yeah, that depends on the perspective. As I said on the top of this slide, my conclusion slide, I think it did create a lot of awareness on tax transparency, and it was basically the first. Ultimately, CBC originates from Murphy, from the Tax Justice Network. He proposed one of the first versions of CBC that was picked up by the OECD. That created awareness, and I think that's really important from a risk analysis perspective. We have a lot of issues with the data because it leads to a lot of false positives. In some cases, you're just simply missing data. So for instance, if I see large income being reported in tax havens, that does not necessarily mean that it's paid from the Netherlands. If you have a multinational reporting a lot of profits in let's say, Cayman, it could also be that those profits are being paid by other countries within the group. So you first need to assess whether it's deductible payments made from the Netherlands. So from a risk analysis perspective, yeah, we're not yet there. Let's put it at that.
Word to Marlene. Marlene, you raise your hand.
Yes, thank you, Willem. The reason why I asked the question is because recently, via a series of regional meetings. Oh, I'm sorry. Good morning, everyone else who's on the call. Morning, where I am. The reason why I asked that question is because regional meetings were held prior to the July adoption of the consensus on the minimum tax. And they tried to ascertain just other issues that developing countries were concerned about. And particularly in the regional meetings where developing countries were, it was brought out that not many developing countries have introduced country-by-country reporting, no, at all. And various reasons were given for that. But one of the reasons, the main reasons, was that developing countries did not see that as a major priority in addressing their base erosion and profit shifting issues. And I know that certainly from Jamaica's standpoint, where we don't have any multinationals that meet the threshold, for us, we would be a recipient country of information. And so we are in the process now of introducing the legislation, but I'm just wondering whether you have any thoughts on how best, how best to convince developing countries that this can actually be an effective risk management tool in dealing with their base erosion issues, one, and the sustainability goals overall?
Yeah, that's a good question. I think, well, there are a couple of points I think which I would like to make. The first of all is a lot of developing countries don't have multinationals themselves with over 750 million in consolidated revenues. I understand that. However, you will also be a recipient of CBC reports. So, in the Netherlands, for instance, we receive 3,000 CBC reports from other countries. Many of these CBC reports are small and medium-sized enterprise in the Netherlands. So even if you have a large foreign corporate, they can have operations in your country, which are not that substantial. So the fact that you don't have multinationals yourself with 750 million in revenues doesn't mean that it can't be interesting receiving those reports, because a lot of multinationals will have operations in your countries, and you only are entitled to receive those reports now if you have an exchange relationship and if you have introduced CBC legislation yourself. So even though you don't have any, probably if you introduce CBC legislation, perhaps you won't even be receiving any report yourself, but that is a prerequisite for yourself to receive CBC reports. So that's the first point. And then second, yeah, from a risk analysis perspective, it's difficult. As I said, there are still a lot of flaws. So we are encountering a lot of issues with risk analysis. But the CBC reports are really helpful to have a broader view of how a group is organized. And for us, it's not a single tool. It's used as an additive to how we treat taxpayers. So it's combined with all the different data sources, like the corporate income tax return and other information from corporate website, or, you name it, basically. rulings, for instance. And yeah, in that sense, it's really helpful because it provides a holistic view of the M&E as a whole. If you have that already, or if your case handlers already have a good overview of how a company is, I would say it's not that helpful itself. Because the comparability of data, that from risk analysis perspective, you want to compare individual M&Es, and that's really difficult because there are flaws in the data. Yeah. I'm not sure whether that's that's helpful.
Yes. That's helpful. Thank you, because my thoughts are aligned with that. But it's just as I said, there hasn't been a very wide take-up on the part of developing countries. So thank you.
And to be quite honest, I'm not sure whether I can elaborate a little bit more on that. But what I find difficult is that it was introduced, CBC, as part of a 3-tiered structure together with the master file and the local file. And especially the local file, that provides information on a transactional basis, individual transactions, and that provides much more detail. But in practice, that's not part of the minimum standard, the local file and the master file. So you only see a few countries proactively requesting the local file information. And I think you would need both from a risk analysis perspective and combine that. And that's something which only few countries are doing. Even the countries which had related party dealing schedules and international dealing schedules for years now, they are starting to combine the CBC data with the related party dealing schedule. So in that sense, you're also seeing tax authorities struggling with how to combine all the different data flows, because you also have data from the rulings, mandatory disclosure, CBC, CRS, you name it. You have corporate income tax returns, you have related party dealing schedules, you have public sources. And yeah, what I'm seeing is that a lot of tax administrations are struggling with that and are now thinking about how to combine all these different data sources in the next couple of years, also combining new technologies and artificial intelligence, etc., etc., etc.
Thank you so much, Willem Jan. We have 2 questions and we have still 10 minutes, so we are okay great on time. And I let you because I think that Marlene has these views from the developing countries that are also important here. I think that also what you mentioned during your presentation, what I think is important is to see that there are not only errors in the reporting, but also problems with the risk analysis. So there are so many things that need to be still addressed. And now we are looking also towards pillar 1 and 2. So the question, one of the provocative questions will be, what can we do while we wait for the pillar 1 and pillar 2 discussion? What can the developing country focus on? Because sometimes I think it's more get the legislation in place, but sometimes it's get the risk analysis and try to get training from the tax administrations, or try to prevent the errors and try to learn with the best practices. So there is a lot of things going on. But one question from Frederick is regarding the participation results, because his question is, what would you say were the main reasons why participation results were included in the OECD CBC standard in the first place? And what are the main reasons for the continuing opposition?
I'm not sure whether it was that deliberately included. I think there was an error excluding certain results. So in 2015, when BEPS Action Item 13 was published, the wording said that intra-group dividends were excluded from revenue. So one of the first things we discussed within the OECD is, why is it only excluded from revenue and why not from profit? To be quite honest, nobody knew. So we issued guidance, the OECD issued guidance on that intra-group dividend should also be excluded from profit. That guidance was published, I think somewhere in 2019 or 20, I'm not sure. But after that, yeah, we as the Netherlands were one of the first countries doing actual risk analysis on CBC data. So we were seeing that there are also other participation results. And I think most of the countries were not aware. We had individual calls with large countries explaining what we were seeing in the data. We held presentations at the OECD, and only then were countries aware, oh yeah, that could be a problem indeed. To summarize, I don't think it's deliberate that participation results were included. I think they made an error excluding only intergroup dividends. It should have been broader. And I think that comment is also being echoed now in Pillar 1 and Pillar 2, because you see that countries are aware and they are excluding also other participation results. Sorry, that was the first point. And the second point was where there's opposition against that. But to be quite honest, I haven't encountered any opposition yet. It's basically that countries are not aware, and in general, some of the countries, I won't mention name, but you will probably all know who they are. They are just reluctant of any changes whatsoever, because they're saying, yeah, that will result in additional administrative burdens for our multinationals, etc., etc., etc. So they don't want any changes at all for these reasons. And I must say, I think if you're talking about adding extra columns in the CBC report, yeah, that will create administrative burdens. I think the point we are trying to make, excluding participation results, many of the MNEs are already doing that, but not all MNEs are doing that. So I think many of these countries who are opposing any changes are willing to listen to our argument, because it results in more consistent data. So it shouldn't have a big effect on the administrative burdens for MNEs.
Thank you. There is a final question from Cassandra, and I think it's important because she's also doing transfer pricing research in African countries. So Cassandra mentioned certain countries such as Rwanda introduced the requirement to file CBC reports in their transfer pricing legislation, but MNEs often do not recognize this as a legal basis. What is your opinion on this practice?
They introduce in Rwanda, they introduce CBC legislation in?
Cassandra, if you would like to perhaps ask the question.
Yes, thank you. So in Rwanda, in their recent transfer pricing regulations, they require MNEs to file the local and the master file of the CBC reports. And so in this country, they have put this in their legal transfer pricing regulations, but also in Uganda, they have been struggling to actually get the files from the multinationals or the subsidiaries, because there they get the comment that they don't have the legal basis to this. And I was wondering what your advice would be to these countries that are struggling to obtain this information.
Yeah, so you're probably referring to foreign multinationals which need to file a group or a master and local file locally in Rwanda. Yeah. To be quite honest, every country is sovereign in its own legislation. So if they are requiring that kind of information being filed locally, there's no law preventing that. I know within the EU, there's a discussion on territoriality. Yeah? So can we obtain data which is about taxes paid outside of the EU? But I think that's a different discussion, because Rwanda is not within the EU. It's their sovereign right. So if they have formal legislation requiring that, I don't see how MNEs can I don't want to talk on behalf of those MNEs because I don't know who they are and I don't know what's exactly in the legislation. But from a Dutch perspective, it's their sovereign right to request that information. It's not part of the minimum standard, but there are many countries requesting master and local file information. You have, I think, in Australia, China, they all request the master and local file from foreign MNEs. and they are actually being filed, Belgium as well. So yeah, if those countries are allowed to do that, why not Rwanda? However, I would be interested in what Rwanda is doing with that information, because as I said, even a lot of the developing countries are struggling to combine all that data. So yeah, it would be a challenge for them to process all the data. Let's put it like that.
Yes, I think they mostly ask it well after their risk assessment and when they are already in the process of conducting a transfer pricing audit. But secondly, I would find it interesting to see what now happens with these requests for information in Rwanda, because now they do have like their national legal basis, but then in the transfer pricing regulations, while in Uganda, they have the practice of asking this information, but they don't have it specifically in law. And apparently this is quite a challenge to obtain it, because the information often has to come from headquarters.
Yeah.
And for instance, the financial managers of the subsidiaries active in the jurisdiction, they often have to report to the tax auditors that they get a no to their request of information.
Well, I can tell you a lot about it. In the Netherlands, we have included it in a formal law. So we have formal law allowing us to request a master local file. We do it a lot in practice. For certain type of companies, we do it always. So for the largest Dutch multinationals, but also if you are requesting a ruling or an APA, we are requesting the master file. I have just been building on a test case for the local file in the Netherlands. So we have sent out 300 letters for local and master file to a random selection of companies. And actually the response rate was pretty good. So these are all foreign multinationals. And I think within the first 4 months, we received 75% of all the local files and master files. And again, they needed to reach out to their headquarters, but we had quite a good response rate. So yeah, I don't know how that is in Rwanda, but that's our experience. And we have a few MNEs which were not willing, but that's really a few. And I think of the 300 letters we sent out, I'm only waiting on one of them to still file. And if they do not file, we will build a court case on that, because there needs to be a level playing field. We don't want them to get away with not filing it once requested by us. So.
And if I may add, because I think that is also important to see that at the moment that the country by country reporting, the rules were being introduced, you also have a lot of discussion as tax administration with tax advisors, explaining how it work, how it was working, what needed to be done, what were the problems, and this kind of openness and dialogue could be also interesting to see in developing countries where normally there is this hierarchical antagonist relationship. So you are not going to be open to the taxpayer, but the taxpayer is not going to be open towards the tax administration. So perhaps this country by country reporting could be also a way to establish that dialogue. Willem Jan, thank you so much for your presentation. It's 12:01, so we are kind of perfect on time. And as you see, half an hour presentation, 20 minutes question, I thought will be a lot, but we have so much to talk about and for today's. And
I could go on and on, Irma, so I will
that would be great.
myself.
Yeah, definitely. Thank you so much. And we will go now to Yvonne Bol. She is also a manager corporate legal and tax at the Dutch Development Bank. She also, as a representative of the Dutch Development Bank, has also dealt with the issue of taxation, sustainability, and reporting. So Frederick will help with the sharing the slides. Yvonne, and hopefully I don't see you.
Yeah, I'm here.
Yeah,
maybe
you're
when
here.
I talk, you see me.
Yes, you do. So
Well,
welcome and thank you. Please go ahead.
Well, thank you very much. I don't see the slides yet. Yeah, they're coming. Well, first of all, I'd like to thank Irma for having me in this conference, because I think for us it's a good opportunity to to share what our challenges are, where we are coming from, and also to get perhaps feedback on the effectiveness of what we are trying to do. Listening to Willem Jan, I relate to a lot of items that he mentioned that we encounter, then from a different perspective. And I think that is exactly what I'd like to share today, to see, okay, what are the benefits, how does it help to have all those transparencies, and what is still needed in certain developing countries. Before getting into those details, I would first like to introduce you in a little bit into what we do as development banks. Maybe also good to mention that, I'll get to that later, that it's not only FMO doing these activities, but all the multinational development banks have put in place the topic of responsible tax. Irma and I have been talking about this and the how and everything for a couple of years now. So we have developed our own practices, but it doesn't mean that we've got all answers to our questions. And I think this is a nice platform for also other people to think along. This is an invitation for people that think we can do better. Because there's always room for doing things better within our own scope. So like my presentation, I'd like to take you along to what we do in general, the impact development banks aim to create. It's very broad. It's on the economic sustainability, economic growth, other ESG items, which obviously also include taxation. I must say that taxation is always mentioned separately, although you can argue whether that is not part of governance. But taxation has a different flavor, as I can assure you. And then obviously from being a responsible tax risk, making risk analysis on responsible tax of our clients. Are we then assumed sort of an anti-avoidance watchdog? Sometimes NGOs like to push us in that direction, but hearing also what Willem Jan says, what is the data that they use, what is their perspectives? So obviously we need to be able to explain a lot of things. So and then I would like to share our challenges, so perhaps that can be taken along in also, I think, in the future in reporting on sustainable tax. Obviously, that would help us a lot if more companies need to report a little bit more transparently. And there's obviously a lot of other challenges that I'd like to mention. But let's first go to the what we do. So the next slide, please. Here's a little bit, you can read from it, but it's coming from our website, is the aim and our reason to exist is to provide financing to private sector companies in developing countries that are considered too high risk for commercial banks. So we want to add value there. We also try to catalyze private money a little bit more by being in the front and taking up the highest risks and take away some of those risks for private investors. How we do it, we do that via providing loans, and like you see there in the slide, syndication, so other parties participating in our loans. We also invest via risk capital, so we do direct equities, but there's also a large amount of private equity investments. We try to carefully identify those private equity firms that have the goals as are described in our investment criteria. Guarantees are increasing to assist largely local small banks, larger banks to actually reach out to the underserved financial. It's really the SMEs, or really the small holders, and it's actually behind the screen for myself. And we do some technical assistance also in helping clients to develop better their internal systems on sustainability reporting and ESG, also under employee benefits, etc. Then to the next slide, please. What I thought was important to mention is also that our portfolio is pretty different, which also means that the way of looking at taxations for those different sectors, we have experienced that that is relevant. For example, the agribusiness and the food and water, it's largely corporate finance, also a lot to do with commodity tradings, etc., which is also a challenging sector, I think, from a tax perspective. We have the energy sector going from corporate finance, but a lot of project finance, which is also, again, a different way of financing. I've had a lot of questions for myself there, how to look at such financings, what is a sustainable way. I read very little literature on that, so maybe also an interesting part of the discussion. A lot of incentives obviously given there. Financial institutions, yet again, another sector which is normally already supervised a lot by central banks, having different norms and standards. So and other products. The Dutch business is maybe not so relevant for this slide. So having said in what field we are working, maybe a little bit on our processes. Obviously, our goal is to create impact in a broad sense. Part of that would be if you create economic growth, it should create also more government revenues. Irma also mentioned that. Is it about government resources, or is it about is it a broader perspective? And obviously, it is relevant whether indeed the economic growth also gives the governments to further improve social matters, social well-being, schooling, etc. So you could argue that that should be something in our investment researches before we invest, that we try to identify whether also that part is being taken into account. So a couple of years ago, I think we were practicing this already for about 6 years, and building on our experience, we have developed certain responsible tax principles. And obviously we closely also follow what is being said in OECD level on the BEPS and everything. So the first question we had is, what is it that we as development banks can do? Obviously we see a lot of clients, we see a lot of structures, very complex. I think we're all in very difficult environments in which we invest. And I guess BEPS was a lot about transparency. So obviously transparency is one of the key factors that is on our list. So what is transparency? Well, that's we consider that transfer pricing and country by country reporting. Obviously, assuming our position is rather, okay, we cannot take the role of a tax authority in our analysis. I think it's rather risk-based. And obviously being a tax lawyer, there is obviously always a very personal interest in how things go, but we also have limited capacity. So we do, and maybe it's also good to mention that our client base is only a few would fall under the required country by country reporting. So I think for us, that is missing out. There's a broad range of, we see a lot of, large investments, a lot of money going back and forth, also just below the threshold in developing countries. So is it sufficient? So at least, so parties are not required to do the CBCR, but all our clients that we finance and have intercompany transactions across the border, we ask them to set up transfer pricing policies. Also, if the country itself, and that's I think one of the notes to mention, is that not all countries ask for the transfer pricing documentation. So for us, it's also how do you get parties to do it? And our selling point is that it will eventually get there in all legislation or in all developing countries. So better to be ahead of that and gradually grow into that habit. And obviously for investors, it also helps to get this transparency on the investee. If they have good administration, it also gives more comfort in the likelihood and success of the company. So what we have introduced, what we do actually in FMO, the tax team, we see every investment that we do from small to big. And we hold those investments against BEPS, ATAP, DAC6. I hope we don't get a lot of other anti-avoidance rules, because maybe also to mention the Dutch Central Bank nowadays also looks into what do banks do in identifying high risks, similar risks. And obviously you can imagine that technically speaking, DAC6 is hardly in our area because it's not within the EU. But it's part of our checks and balances that we do. On the offshore, I just mentioned it one word. Maybe interesting to mention that most of our stakeholders, being NGOs, ask, what do you do with blacklisted countries? Whereas I think that is not really a tax analysis in itself. It's as if when we would not allow any of our clients to have any entity in a offshore jurisdiction, whether that would, or a listed jurisdiction, whether that would solve the problem. There's a lot of structuring that can be done with non-blacklisted countries. So I always try to explain that we rather make an analysis of a structure than just checking boxes of lists. Having said that, I think most of you would know that a lot of investments into developing countries are structured offshore. And here's, I think, the note that I made is not that all our investments are into, if we invest, if FMO provides a loan or any development bank to a multinational that would have CBCR requirements, we often finance one element, because you could argue, why are you financing such a multinational? It's usually because they are getting into a high risk project, which we'd like to stimulate. So obviously we're only focusing on one subsidiary of the whole multinational. Nevertheless, we do inquire after the CBCR. Like it's also mentioned in our earlier presentation, do they share it with us? Some do, or at least the summary, and some are obviously quite reluctant why they should share it with us. But for us, it's rather a confirmation that it is in place, than that we make a full risk analysis, because it's simply impossible for us to compare any data and what they do is correct, but it's more pushing for the transparency. Also, a note on the offshore. Like I said, there's a lot of, we also invest through private equity funds. In our challenges is that that sector, whereas there's a lot of money going on in I think, the such investments. Also, you see large foundations investing in trying to do impact investing. Offshore entities are usually used to pull all the investors together. So there again, it's a different way of looking at the structure than when you look at a multinational and the functionalities. So these are challenges we have to take positions in whether something is too high a risk for our risk appetite. What we there again also look at, obviously, on especially the base erosion on money shifting from the industry company, which we obviously want to see develop further in their economic activities. So in the developing countries, that there's no money shifted via fees or interest payments to those equity funds. So those are our attention points. Also there, so I'm just taking you along with the challenges we have in what are our principles. Project finance, like I mentioned, is a different game. Often you see that a project is developed just in one project entity. So it's not really part of a corporate. And in the financing industry, it's quite common that the banks require the asset to be separated from the corporate because the financing is only going for the project and not to finance any other matters of a corporate. So they want to really ring fence the financing, which leads again to structures that may appear quite aggressive, but I think the holistic picture is quite relevant for us there. Obviously, if you look at renewable energy projects, even in developing countries, a lot of incentives are built in. So question is, how relevant is taxation in that respect? People argue higher taxes mean higher energy costs, so effectively not helping the developing country getting better served in the energy sector. But that could be debatable, but like I said, those are the challenges, and we're trying to find our ways to make it, to assess the risk and when it's acceptable. What I also like to mention, obviously not really part, and so we've talked about a lot of the CBCR, but I think our, how you said it, environment looks a little bit different. And I talk a lot also to clients and other parties, in how to address our risk analysis. And people say it's not only about the multinationals. There's a large group that is not really getting sufficient attention in how they are actually contributing to the government revenues. And there's, like I said, there's a lot of private capital reinvesting. Are those underestimated in how they can contribute in their own countries? And obviously we see that a lot when we do our KYC procedures as a bank, understanding where the money comes from. So I think there's a lot to be done also in other policy levels to ensure that people contribute. So I can also on this topic, I can continue for a while, but maybe I should try to get back, and I don't know, maybe I can get some feedback whether it is interesting or not to continue, but we can get back to that later. Maybe get to the next slide. So for us, the question, we put a lot of work in analyzing our clients. Again, how do we do that actually? We ask, most of our clients need to report under IFRS standards. So we rely a lot on what is reported under IFRS. Obviously, we need to understand going through the years, what do you see in IFRS reporting on taxes paid? There's a tax on the profit, but is that really what is paid? So you look at the cash flows, maybe they don't really align. So we have our kind of analysis, and obviously we can ask our client to give some more explanation. And we, when available, we also try to make the ETR calculation and try to explain perhaps why certain companies are not paying that much taxes, and we need to qualify whether that is still okay, yes or no. Again, going to the project finance, development banks, they step in an early stage, so it's only construction, etc. And usually when construction is over, then the company starts creating results, and usually then our loan has stopped, or we try to sell our shares in the project to commercial parties. So if the reporting tax would be 0, is that then bad? So it requires a lot of additional wording, storytelling to each reported item, I would say. And I think that's also part of, and maybe what I forgot to address is, like we say, in all our financing, I said that we have the other ESG items. Obviously, we are also facing the EU taxonomy on sustainability and reporting, a big challenge for developing countries and clients in developing countries. So that's also on our agenda, where then I think it was wise to also start thinking about this tax reporting. But it would be very helpful if people take into consideration the broader perspective than maybe only the multinationals. I think, let me go. So I think what we are doing, and that's what I've learned from getting connected with our clients, discussing their tax positions, discussing this with private equity funds. We push for policies, and we also try to, in our direct investments, push for tax control frameworks, because it helps us to understand what tax risk they have and how they address them. But you can imagine that requires resources. So maybe a little bit like the EU does a lot of policies, but then the next step is the monitoring, which is obviously very challenging and assisting. But I think in the end, looking forward, impact investors do appreciate more transparency by the investees. So that's what we try to explain to get cooperation. Obviously, our position as a lender is not always that we have the legal means to require a lot. So this is really built on relationships, and be mindful that taxation is not the only argument to invest in a company. There's a lot of other development impact that can be made apart from taxation, so we need to balance that out. And I think for us, indeed, the question is, what should companies report on tax? When is it sustainable? Is it only about the profit taxes, licenses, etc.? Withholding taxes, I see very little reported on that, whereas I think it's coming from IMF, all stimulating withholding taxes. Personally, I'm not so sure whether that is the holy grail, because it also makes it already quite expensive to at least to start an investment. Obviously, we're looking from it a lot from investor perspective, investors that take risks, they need to have some kind of balancing between their returns and the risks. I think it's fair to say on the item on all the anti-avoidance rules that are implemented. I know also from other DFIs that part of our risk mitigants is that we identify that countries have exchange of information agreements in place. Whether that is something we can actually rely on is then the question, but yeah, you can give me feedback. It would be very nice if we could, because then our rule can stop. And again, like I said, what information do financial statements give? It's usually quite a big puzzle. It requires understanding of reading financial statements in the right manner. And not all parties do it in a similar way. And some of them are more transparent than others. I think it also might depend on whether they are on a stock exchange. But nevertheless, it can still be assumed. And I think that's also the debate we have as development banks. When is it okay? Is it okay when it's according to the law? Or is it okay, is it sustainable when the public thinks it's okay? And then referring to NGOs. And I think we've also heard in Willem Jan's presentation that that is not always aligned. Maybe go to the next slide. I think there's a little bit repetition here. Again, CBCR, what can we learn from it? Is it the Holy Grail? I think it would be informative, I think, for impact investors to also understand the level of effectiveness of those regulations. So maybe the interaction between the various practices without obviously sharing data that cannot be shared, but understanding the level of reliance on that. Similar goes for exchange of information. If I see that say a assumed tax haven has exchange of information with the country of a client, then I would like to assume that it's sufficiently transparent and we can be less critical, for example. But obviously we usually test on the level of transactions that take place between those entities. Maybe again a repetition, what is sustainable taxation? I've been in some discussions, but I think it's going back and forth, very difficult to, some of the DFIs report on taxes paid in the developing countries, but they use the data coming from financial statements of our clients. So in my view, that is not really something not very reliable, because that's not really what they've actually paid in the country. And I don't think IFRS really has that kind of required information. It's a more of a cash flow kind of thing. But more explicit information could be useful. Then it reduces the puzzle we need to solve. And perhaps there could be more distinction between the various sectors, what is expected. I think in the, obviously what is it, the e-commerce, they're seeking to get some levy on turnover. So it could be, what is it wrong if participation results are exempt? It's often assumed as foreign cash flows going out, but then these fall under those typical exempt rules, have for us following legislation that is then should be okay. So I think these are just sharing the challenges we have, the questions we receive, also from the public needing to explain. So if we can rely on that let's say policymakers and tax authorities would agree on our analysis, I think or that we have discussions on that is obviously very helpful. Maybe go to the next slide and I quickly check on my notes whether I've missed something.
Yeah, Yvonne,
Yes.
I think that we have like 1 minute because I have like 4 or 5 questions for you in the chat already.
Also fine. I think I've covered most of the things I wanted to say. I think I've mentioned all those while going through the topics. Maybe the last one, it sounds a bit, is it a fair argument? But a lot of investors encounter also some that they cannot really rely on how tax authorities respond to the information they give. So maybe I think that's the argument maybe in why multinationals, I think they do share a lot, but that others that they would not want to share because giving more information leads to more litigation. So maybe not to underestimate the level of sophisticatedness of and technical assistance that might be needed in the developing countries to get a balanced relationship between the taxpayer and the tax authorities. I think in the Netherlands we're pretty lucky with how we can discuss matters. But I think that's also what we've seen as FMO ourselves. We've been required to pay taxes where we should not, but getting that into the discussion only means that we need to pay fees to tax authorities, which is obviously not a, so these are also practices that are there, but are not part of political discussions on fair taxation. But so I'm there from the practice to share also these insights with you. So thank you for giving me the floor to share this with you. And I'm really looking forward to further discussions.
Thank you so much, Yvonne. We have some questions in the chat, but I see that Willem Jan raised his hand and maybe it has to do with the last argument, point that you mentioned with the tax authorities. So let me give the word to Willem Jan and then after we address the questions in the chat. Willem Jan?
Yeah, thanks, Yvonne. I think we're quite aligned on a lot of points, fortunately. And I did want to echo your last point because when I was a Big Four advisor, I also was advising a DFI investing in developing countries. And when we were pressing for more tax transparency from their investees, a lot of these investees were saying, yeah, if we are transparent, the next morning we have the tax administration knocking on our door. And I think that's, yeah, I don't have a solution for that as well, but that is a difficult one. You want to be transparent, but on the other hand, you don't want to walk into all kinds of audits and all kinds of difficult discussions. So I want to echo that.
Thank you.
Thank you, Willem Jan. And let me get to the first question that is Alice Jones. And the question is, Alice, please, if you feel like you need more information, to give more information, just please feel free to intervene. Does the level to which a company is tax responsible affect the investment they can attract, and how?
Yeah, that's the good question, and I think a continuous dilemma. And I think we are improving in discussing items with our clients. If it would appear that their tax behavior or tax policies are not within our risk appetite, I think we always have two options. It's either not invest, but does that help? or we do invest and we set up some action items that we require from them, and we see that as part of our generating impact. And obviously, we would like to do the latter, because obviously if the tax, if the other, we have a couple of investment criteria that are tested, and if the impact on labor, for example, employment is enormous, then obviously we have an interesting debate on that internally, but these are the questions that are addressed.
Thank you, Yvonne. We have another question from Parvati Sebaluk. Any responsibility regarding CRS and FATCA issues with respect to dealing with clients' accounts?
Can you explain a little bit more?
Parvati? Let's see if he can intervene. Parvati, the floor is yours. Oh, we don't hear you. You are mute. Let me see.
You can hear me.
Yes, now
Yeah.
we can. Yes.
When clients go to banks to open accounts, and in this case to ask for loan and advances, is there any possibility? Is there any criteria, any requirement to ask for information for the purpose of opening the accounts, information regarding CRS or FATCA, where the client is resident, whether resident in both countries, in the resident in the country of residence and other country as well? Is this issue, does this pose this issue?
Well, maybe it's good to mention that we don't open accounts with clients. So we don't have really FATCA and CRS obligations. We are more an investment bank.
Okay.
So we rather look at it when, for example, when we look at a investment and we look at the ownership structure, and in many developing countries, let's say wealthier people put their money offshore for various reasons. And then the question is that an issue for us? But if there is an exchange, then technically speaking, those banks should report to their country of residence. And maybe if I didn't mention that, but while doing these, and this is actually part of our KYC, what we call round trippers is that people, they live in a country and use an offshore entity and invest back into their own country. These are for me the most challenging, or I always say that gives me bellyache. But so we ask why do they do it? And often it's because of the political instability. But what we also noticed is that a lot of countries don't require any taxation, or I don't have liabilities on wealth tax or inheritance tax. So the question is it then really, are they avoiding taxes by having their money offshore? That's then an interesting question that we sometimes have.
Yvonne, you have another question from Willem Jan, and because we have 9 minutes, Willem Jan, would you mind to ask the question directly?
Yeah, sure. Now my question was basically, first of all, I assume that you are sending out a questionnaire to these investees. Is that correct, Yvonne? Or how does that work in practice?
In practice, I am not in favor of questionnaires, because you always get the desired answers, check the boxes. We don't, as such. Before asking questions, we do our initial analysis based on the information we have, look at the group structure, look at what they do, and then formulate specific questions. And sometimes it goes back and forth. So we are not so happy with check the box, and usually and like I said, by developing our practice, we've also decided that we want to have more connections, that we have meetings with them. Nowadays, with all the Zoom, it's easy to run through what they're actually doing and have immediate feedback.
Okay, thanks for it, because that basically feeds into my second question, and that's are you or do you agree with me that state-owned entities like FMO should also do more on publishing themselves how they do their due diligence and how they incorporate that into their investment process? So do you understand the question? So what you see is that some of these DFIs, they are really transparent also on how they do their due diligence and what they think is important. Yeah, is that something you agree with, or?
Are you then specifically pointing out to that we're not transparent enough?
No. I'm not referring to FMO, but in general for DFIs, I think, in my view, I think it's very important to show to the world how you're investing and also what you're looking at from a tax perspective. So objectifying that and being transparent on that.
Yes, I would agree, but I think I would also argue that quite a number of them already do so. We had our personal discussion on our own website, which needs to update, but it's always interesting to see how politically things go to get something on the website. So we are trying to be transparent in a way, but yes, I think to be quite frank, that's why I said in the beginning, having this floor is nice to get challenged on what we do. Also, not only like you're not doing enough, but rather from experts to assist. So in the terms of positive feedback, how we can be more effective, being mindful of that we are not tax authorities. And we really like to be the role in pushing for transparency so that tax authorities can do their job better. So I think that is
yeah, thanks for that. That's really helpful, Yvonne.
Thank you so much. We have two questions. I will give first the word to Frederick. Please ask your question. And we have 5 minutes, so let's see how far we go. But in the meantime, also, you can also ask questions in the chat, because after the lunch break, we will continue. Frederick, please go ahead.
Yeah, so what I was interested in, what I found very interesting, is that you said that as FMO, you asked companies to establish basically transfer pricing policies, and I'm not sure if I understood also the documentation or not, and even if they're not required to do so. And I wanted to ask you to elaborate a bit more on this, like how do you do this, and do you know how effective this is? Is this kind of an exclusion criteria, or is it on a list among different criteria? And do you have any information on if that changes something in tax payments of companies, like compared to a situation where they didn't have any transfer pricing policy?
Very good question. So into the how, there's a couple of things. Is indeed, like I said, we connect with clients, ask whether they have transfer pricing policies. And if no, well, I think everybody knows that it takes quite a while to get a transfer pricing policy in place. Obviously, we're also mindful of that not everyone has a lot of means. So I'm always hesitant to push people, clients into costs. But how we do it is sometimes it's a long way and a lot of discussions. But we ask for it usually to do that within a year. So it's not a condition before we pay, but it's something that they need to have in place after a year. And so we have systems in place to do sort of get a reminder on that. We have actually limited our action items, what we call it, to 2 items so far, which is transfer pricing and tax policies. And tax policies is rather, I think, psychological item to create awareness, because a policy is something you put on paper, but you don't necessarily do it in practice. And your second part, the effectiveness, that is something which is pretty difficult for us to do. I would very much be interested to make statistics. But that's also, I think, looking into the future and having sufficient capacity available there. But it's a good point. And
Thank
maybe
you.
a critical note there that sometimes transfer pricing policies come from one country, the headquarter. And I'm not always certain whether the same is applied in the other country, because I've been told that you don't necessarily need to use the same arguments in country 1 and in country 2, which I think is a flaw maybe in the whole transfer pricing documentation guidelines.
Thanks. Yeah, very interesting. Yeah, I think it depends whether the other country even has transfer pricing legislation or whether it has one that is diverging from the headquarter.
Yeah.
Let me give the word to Willem Jan, because he wants perhaps from the tax administration to give some perspective. Please go ahead.
Yeah, that's just a really brief addition, because in Pillar 2 there's a TP mismatch rule. So if countries are introducing Pillar 2, TP mismatches will also be eliminated. And actually, it's one of my worst nightmares. I think that's an overlooked item of Pillar 2, which will create a lot of burdens for multinationals in practice.
Thank you.
Yeah. So we are 12:49. I say we stop here. There is also one question from Juliana Cubillos in the chat. So we will please, Yvonne, feel free to reply to that question. So we will continue. We will have 1 hour lunch break or working break outside the conference for whoever wants to, has some, of course, lots of things to do. So we will start at 1:50 with Danuše Nerudová, who is professor of economics at Mendel University. And then after we will have Marlene Parker from the tax administration in Jamaica. And please do not forget that after this session, we also have the second session that is being led by Thomas Burnett and Florian Regli. So we will wait for you at 1:50. We will join again. You see also in the chat, if you have problems or to communicate, to contact, to link Zoom, just send us an email. And looking forward to see all of you in 1 hour. So in 1 hour, 1:50 Dutch time, whatever time is in Latin America or in Asia, and so we will see. Thomas, thank you, and see you in, oh yeah, you were, yeah, okay. So we will see each other in 1 hour.
Taxation. Even though that you will see that the model is aimed on the policy of the EU 2020 agenda, it's designed in such a modular way that that can be used in any time. And it's just about inserting the policy and the flagships and the targets European Union or any platform or any state would like to follow. And it is especially up to date today when we have a new EU agenda, we have a new EU budget aiming for slightly different aims than 2020 agenda. But still, if you insert this aim and policies which European Union would like to follow through financing the budget, this model, of course, can be used, and it's even more up to date. I'm not able to. Can you see that I just changed the slide?
No, we don't see that
No.
one. We see the same slide.
Yeah, because it's not working. Huh. Do I have the right to move?
Yes, you are co-host.
Which?
Dear Mrs. Nerudová, sometimes it helps just to go back and then share again.
Okay, so do you see number 2?
Yes, we see number 2.
Super. Thank you. Thank you very much. So,
excuse me, just a little remark. We now see you not in the present mode, normally in. Yes, so now it's better. Yeah, thank you very much.
yeah, can you see it now?
It works.
Full screen? Super.
We see it. Thank you very much.
So as I have been mentioning, the aims which are inserted into the models are the aims which are in Europe 2020 strategy. Therefore, we are talking about that we should aim for smart, inclusive, and sustainable growth. And we have been dealing with the fact how this should be reflected in taxation policy and what is the role of taxation policy in this Europe 2020 strategy. And of course that we have been dealing also with the fact how taxation policies, which are quite heterogeneous across the EU. There is no common taxation policy in the EU. We can just see the common trends, but it's set up on the national level. So how these heterogeneous taxation policies can contribute to overcoming the crisis we have with connected with the sustainability. We have been looking also on the fact that it's extremely difficult on the field of the EU to coordinate taxation policies, that there is a great fear against harmonization, especially in the era of corporate taxation. We have reached much more higher level in the level or in the era of indirect taxation, and we also have been mentioning there new challenges which EU states have been facing, and we are all quite or we all know these challenges, which is, for example, profit shifting, tax-based erosion, tax evasion, tax fraud, digitalization, and so on, and the techniques which are used for tax planning. And we have been discussing the fact that even though the European Commission is applying still, if you look on the recommendations which are the member states receiving in Europe 2020 agenda and recommendations which are countries receiving in European semester, all those recommendations are based on the strategy taxing for growth. And we started to think that maybe the strategy should be changed and we should be talking about the strategy taxing for sustainable growth. And that's why we open up the concept of sustainability in taxation and how to measure whether the tax system of the country is sustainable. So in fact, we propose a general concept of tax system sustainability. We have developed a model which can be applied on any EU member state or any state. And the model is also general enough, as I mentioned at the beginning, that you can actually take any strategy, you can change the policy areas, and the model is general and up to date and can be used for example, Fit for 55 strategies. When we have been going through the literature, we have found out that there is lack of strategy which would be dealing with tax system sustainability, that we have a literature which is concentrated on just a general concept of sustainability, which, as we know, is based on the principle of intergenerational equity. We are talking about the fact that every generation should be behaving in such a way that shouldn't limit anyhow the decisions of the future generation. And also we have been searching through the literature on a multidimensional view of sustainability that probably you are aware of Brundtland report and the dimensions of sustainability that they are talking about the economic, environmental and social sustainability. But with respect to taxation, we are talking about another view, which is the institutional view. And we consider the institutional dimension of sustainability in connection with taxation system as the crucial one. Yes, this is about the literature. I will skip it. And how our concept is based, we departed from the priorities of the current generation, therefore from the concept of intergenerational equity, but we also tried to reflect this multidimensional view, and based on this, we came up with our own definition of sustainable tax system, which is quite new because it hasn't been comprised in literature before. And we defined a tax sustainable system of a country as the tax system which comprises tax tools and tax related legislative measures, which are contributing in a sufficient manner to sustainability of economic, social, environmental, and institutional dimensions. And on top of that, such a taxation system should support meeting the needs of present generation without compromising the future ones. This is what I've already been mentioning. So this is the scheme on which the model is built on. We have 3 pillars which are stemming from a general concept of sustainability: economic pillar, environmental pillar, and social pillar. And you can see that we have an institutional pillar, which in fact is some like an umbrella. And you can see it also that the arrow is on different direction, because we really do see the institutional pillar as the must for reaching sustainability of the taxation system. What we do consider as an institutional pillar, for example, legal framework, compliance, and think like this, functioning of the institutions. So this is the institutional pillar. And if this pillar is not sustainable, then it's really difficult to reach sustainability of the taxation system, because you do not have the enforcement of law, you do not have the legal framework and things like this. So there was, let's say, this theoretical part, and then we had a practical part, how to really design the model and how to construct a tax sustainability index. So we departed from the definition of tax system sustainability, which I've already have been mentioning, that it is based on those 2 general concepts. Then we technically defined this tax sustainability. We defined it in the European 2020 agency dimensions, which is in fact the economic dimension, social dimension, institutional dimension, and environmental dimension. In these dimensions, we have defined policy areas, and within those policy areas, we have been searching for tax tools and tax legislative. Yeah, sorry, but is it recorded already? Yeah, super. So we, in fact, we have been going through the taxation system, and we have been searching for these tools and measurements. We have been formulating the questions, then we have been collecting the data, and we had applied the model, and through the statistical methods and the validation, we did also the evaluation. And you will see it on the case study of the Czech Republic. We have defined also sustainability, strong sustainability, and we have defined unsustainability in this certain certain policy areas and in this pillars. And at the end of the day, when we had these individual indexes in each area, then we constructed one tax sustainability index for each country. So just a brief taste how the sustainability in each dimension and policy area is constructed. This is on the example of economic sustainability. We have been, we had those questions and measurements, and we defined that if at least 1/3 of the instruments were comprised in taxation system, then we do consider this dimension as sustainable. If it was less, it was considered as non-sustainable. And of course, the same was used also in a social, environmental, and institutional pillar. So we also defined social sustainability, environmental sustainability, and institutional sustainability. And we conclude that there is a strong sustainability if at least 2/3 of the measurements in the taxation system is comprised. This division between sustainability and strong sustainability is rather technical. It's very much connected with the statistic. We have used the methodology which have not been used before, and just not to confuse the people who are dealing with statistics. I'm not a statistician, but it's different from the methodology which is used from Dasgupta and Davis. And tax system in together is sustainable when at least 3 of 4 dimensions are sustainable. So this is how the intestines of the model look like. So we have policy areas which you can very easily change. We decided Europe 2020 agenda. So we have smart growth potential. Then we are searching for tools within the taxation system which would support smart growth potential, for example, tech tools for supporting of innovation activities. And then we are asking the questions. For example, does the tax system provide special treatment of R&D costs? Does the system provide, for example, a preferential treatment for intellectual property rights? Here, I would like to mention one fact that, of course, this in the economic pillar can contribute to smart growth potential, but in another pillar, it can have a negative consequences because it's very much connected with tax evasion and tax fraud. Therefore, to avoid this bias, the question is posed twice, and in the different pillar, it has a different value in the calculation. So here it's positive, and in the pillar regarding, for example, the social thing, it has a negative value, just to limit those situations when in one policy areas this is the effect is positive, and in another policy area the effect is negative. So we had 3 types of answers and questions. We had binary answers, yes or no. Then we had numeric answers with the fact that the higher the value is, then it is better. And then we had numeric answers that the lower value is, then it's better. So those are the 3 types of answers. Then we ran 4 scenarios because, of course, that we have we had a lot of measurements, and we need to cluster it somehow to create the groups. So we ran scenario 1, where there were equal weights for each measurement. Then scenario B, where we clustered small groups and each small group had equal weight in the measurement. Then we had a scenario C. We had larger groups and there were equal weights of larger groups, but still small groups were present in the model. And then we had a scenario D where only larger groups were present and they had equal weights and no small groups were present in model. So this is how this scenario A, B, C, and D was done. You can see it in the equations. This is the economic sustainability. And then this is the construction of the final tax sustainability index. And that in fact, it's constructed as the partial index in each dimension: environmental sustainability, institutional and economical, divided by 4. And that's the final tax sustainability index. So you can see here the results for the Czech Republic when run through scenario A, B, C, and D. You can see that the results are oscillating according to certain numbers. We also were trying to reflect this in the pictures to make it very easy for the policymakers to see in which policy areas they are not sustainable. So we transferred that into such a polygons. So you can see that the red color means sustainability, the gray one means strong sustainability, and the blue one is the result of the Czech Republic. So you can see how we perform in each dimension, and we are very weak and we are not sustainable in the environmental part. Because in the Czech Republic, in fact, we do not apply any ecological taxes, which is at the moment a big discussion because our economy is going to be hit very seriously by Fit for 55 plans, because we have 28% of industry in the country, while the others country in the EU have 21% in average. So there is quite a discussion about the introduction at the moment of ecological taxes in the Czech Republic. And the construction of the model is so modular that the policymaker can look on the area of environmental dimension, and he can go through the intestines of the model into the questions, and he can see in which partial things he has a problem and in which partial things the taxation policy should be modified. So yeah, this is the summary of the Czech Republic, that overall it's sustainable, but we are not reaching sustainability in environmental area, and we defined the critical areas, climate change. We do not have any measurements in taxation system which would be dealing with climate change. We do not have any tool to support green innovations in taxation system, and we also do not have any support for renewable energy and recycling. So in fact, we do not have any taxes on waste or plastic bags or plastic something. Nothing like this. They are not applied in the Czech Republic. So to sum up, we just developed the model which is able to measure the sustainability of the taxation system. It is modular. It allows a policymaker to see the performance in each dimension of sustainability. It allows the policymaker to formulate a very detailed taxation policy, because it has certain areas in which the policymakers can see that the taxation system is sustainable. It can be flexibly changed, and at the moment we are trying to change the model to the intestines and try to reflect new policies which are comprised in new EU budget, and also the policies which are comprised in Fit for 55 agenda. So I expect that we will deliver results also for other EU member states. Thank you for your attention.
Thank you so much, Dana, for this interesting presentation. I think that what is also important to see is that this sustainability index started as a project within the Fair Tax project, but it can be also used by other countries. So perhaps one interesting item for you is to see how this, what do you see the usefulness of the sustainability model index also in developing countries? I believe that, for instance, the next speaker will be Marlene Parker from Jamaica, and you were also presenting that in Curacao, so I know. So I was thinking about how they can also use the sustainability index. Perhaps you have some reflections there, and then after I will open the floor for questions.
Yes, thank you very much for this question. Yes, I have been talking with people on Curacao just in the moment that in which they have been trying to design a normal taxation system. And yes, it can be used for developing countries because it's really general, and you can really reflect the strategic things into the policy areas. So it's really useful for policymakers, and they can really decide which aims they would like to have in the model, and they can, according to this, they can try to design taxation measurements in taxation system. So yes, it can be also used by developing countries.
A follow-up question, because do you think that the most important challenges will be, like in the Czech Republic, was the environmental part?
Well, environmental part was before COVID. After COVID, we will have also challenge in the economic pillar, because as any other country, now we have huge deficits. Therefore, we also have problems with sustainability in the economic pillar due to the sustainability of public finances. Therefore, with respect to COVID, we will also redesign the part of the economic sustainability.
Thank you, Dana. I will give the word to Frederick. Please, Frederick, ask your question.
Yeah, thank you. One question, or what I would be curious is if you could tell us a bit more about how you select tools that are in specific policy areas that contribute to sustainability or not. And yeah, this comes from the background that, of course, their policies can come in, I don't know, in very many different varieties, also across countries that that you can imagine. So I was wondering, how did you go about this challenge?
Yeah, thanks for the question. Yes, it was extremely difficult. We went through all the taxation systems in EU 27 countries. We saw the measurements and tools which are used by policymakers, and we had a huge brainstorming in the team, and we had a discussion which of them we should identify, which of them we should search for in taxation system, and also we some of them which are part of the model are also based on taxation theory. And yes, we had, it was really vast file of measurements we at the beginning had, but of course that at the end of the day there came some kind of reduction, and also the discussion regarding the role, as I have been mentioning, of certain tax tools and measurements in certain pillars, because they can really have a different value for the pillar. As I mentioned, the IP box regimes, which is perfect to have. On the other hand, it's negative issue regarding the economic sustainability, but it's good for smart growth potential. So so this was also the issue to solve this. but I'm not the statistician person, but they have find the way how to eliminate this overlaps, in fact. Yeah, overlaps.
Thank you so much. I have a question here from Hans Gribno, also a colleague and professor at the Leiden University and Tilburg University, and who has been also working in tax governance here in the Netherlands. Hans, please go ahead.
I had to unmute, sorry. Yes, thank you very much. I have a question. Perhaps you dealt with that, but apologies then. But my question would be referring to your example of a tax on plastic bags, which is apparently not in the Czech system. Is it okay to have a tax sustainability index without taking into account the larger regulatory environment? For example, Ireland has a prohibition on small plastic bags, so it has no tax. It has no need for such a bag tax, so to say. So if you then say, okay, Ireland scores lower on the index, that would be a bit strange, isn't it?
Yes, it is. But I just mentioned the plastic bag tax as the example of environmental tax, but we do not even have a tax on the extraction of natural resources, which is quite a common tax. For example, in UK, we do not have something like this. And on top of that, the regulations which are standing outside the system, for example, European ETS, which in fact should be kind of environmental regulation, in countries, for example, like Czech Republic, in fact, do not play any role because the limits were set from 1990, which means that our limits for the decarbonization are very, very low. And on top of that, for example, Czech Republic, and not only Czech Republic, but also the Slovak Republic, and I'm pretty sure that Hungary is always doing that, they are subsidizing this, which in fact those tools are not playing environmental role in certain countries. So that's why we really also took into account those things, that even though they should regulate environment somehow, in fact, in certain countries do not play a role.
Well, perhaps I'm not very clear, but I would say you could promote, let's say, employment by tax incentives, but you could also promote it by subsidies, direct subsidies. So if you, let's say, build up some kind of index as you do, shouldn't you also take into account, let's say, the non-tax alternatives?
Yes, we also have a non-tax, in some areas we have a non-tax alternatives in there, not only in taxation system. Yes.
Okay, thank you.
Yeah. But because, for example, in a social area, we also have some tools which are standing outside a taxation system.
Thank you so much, Dana. I also have a question, and this is kind of a historical question. Because you started this project and you started working on sustainability around 2014, more or less. We are in now with the EU 2020 strategy, where there is a lot of attention to environmental issues, more than ever. And my question to you is, what will be kind of like the lines that you will see from the beginning until now? Is there a trend here? You say, yes, indeed, it's more environmental right now, or like you just mentioned before in COVID, now it's also economical. How do you see that you have to now to adjust your model because of all these developments?
Yes, we have to adjust the model, especially in the dimension of the digitalization, because 20% of EU Generation X should be aimed on digitalization. We are talking about a digital tax as a possible source of new own resource of EU budget, not mentioning the initiative on OECD level. So this is the part of digitalization and the digital economy, which is playing a huge role. And regarding the environmental issues, we also have to change it, because even though we considered in 2015 or 16 Europe 2020 strategy as quite ambitious, I have to say that this Fit for 55 plan is the most ambitious thing I think has been ever produced by European Commission in the era of environmental, or in the era of protecting the environment and decarbonization. And it comprises a lot of legislative measures which are going to have a vast effect on economics and of course on the environment. Therefore, we need really to redesign these policy aims which are comprised in the model.
And then I take another tricky question, because I am always fascinated with the sustainability index. And one of the questions that you say is about the institutional factors, and say about the compliance and the functioning of the institutions. But this is kind of a problem with developing countries. So then you have this in the EU, that you have this digitalization and of course the environmental, but you also see this institutional. So how do you see that this, is there a difference, and how, because we are always talking, for instance, in transparency now about how many initiatives for transparency and how difficult it is to find the resources in terms of personal funding and so forth. So how do you see this institutional factor?
Yes, as I mentioned, the institutional pillar is the crucial one. In fact, it's an umbrella, because if you do not have an enforcement of the law, if you do not have a mechanism how to collect the tax, then of course that it's the basic precondition of applying any taxation system. So if there is no institutional sustainability and you don't have the institutional pillar, then of course that the sustainability of taxation system is endangered, of course. And this will be the problem of developing countries, and that's why they should really at the first moment they should focus on the institutions, the institutional pillar, which in fact is happening, because as I have been listening to the discussion on Curaçao, they need to build an infrastructure for collecting the taxes, and yes, this is the primary task for developing countries.
So much, Dana, because that gives the nice floor for the next speaker, and that would be also Marlene Parker from Jamaica, not only a small island, developing country, and also working at the tax administration, and she will discuss the Jamaica implementation of the SDGs and the role of taxation. So please, Marlene, thank you so much, Dana, for your presentation. And Marlene, the floor is yours. Please go ahead.
Thank you. Thank you very much, Irma, and thanks for having me. It has been a fascinating discussion so far. I'm just wondering if Frederick could put up the presentation. And while he's doing that, I'll just give an outline of how I intend to go through the presentation. So I'll open with some introductory remarks, which gives an idea of the linking of Vision 2030, which is where we started, as I imagine most countries would have. Thank you. So could you just go to the first slide, please, Frederick? So the introduction really links our Vision 2030 plan, the National Development Plan, to the SDGs. And so we started out as far back as 2009 to discuss this issue of what we wanted Jamaica's road to development to look like. And so in my introductory remarks, as it points out there, that this was our first long-term and strategic national development plan, was regarded as historic in Jamaica. And it was aimed at advancing the achievement of developed country status and ensuring a secure and proper future for all Jamaicans. In 2017, Vision 2030 and its medium-term socio-economic policy framework, otherwise known as the MTF, was identified by the government of Jamaica as the mechanism for implementing, and a roadmap came out of that process as to how we are going to target the implementation of the goals themselves. Next slide, please. And so the goals, as well as Vision 2030, were linked at that point. The targets of the MTF became the mechanism through which the goals will be realized, and the MTF will be supported by consistent monitoring, evaluation, expanding and strengthening of the financial mechanisms for implementation. Jamaica has chosen to use a voluntary review in order to determine how we are doing with the goals. So we don't have an index as such, but I was just listening to, is it Danuše presentation, and thinking that we really and truly should investigate using something that will really measure how we are doing with the goals. Next slides, please. And I'm just going to give you some list of what we have achieved since we adopted the SDGs in 2017. We have approved the medium-term socio-economic policy framework. We do quarterly reports on the Vision 2030 plan. We have engaged our entities in capacity development. We are advancing the achievement of the goals through the 2030 project supported by the UNDP. And we have also engaged our municipality corporations. We have built out an online, sorry, next slide, please. We have built out an online monitoring platform for Vision 2030 to monitor the contributions of our development partners. There has been gain in terms of macroeconomic stability. There has been reduction in unemployment and an increased use of non-fossil fuel. I should say that in terms of Jamaica's energy dependence, it is primarily fossil fuel. Wind and solar only form 12% of our energy use. We have developed an effective governance framework for Vision 2030 and the sustainability goals. But as I will point out later, there is a significant stakeholder which is missing from that governance framework, in the sense that the Ministry of Finance, nor the TAGA, is a part of that framework. And so when I come to speak about financing the goals, and particularly taxation, it's one of the recommendations that, that I will make. We have seen some economic growth in tourism, agriculture, and quarrying. Next slide, please. Well, of course, all of this is pre-COVID. And so we have not yet been able to measure the year 2020. We have seen a fall off, of course, in many of these activities. And so to some extent, the goals, the achievement of the goals will be derailed. And I suspect that Jamaica is not the only country that finds itself in that position. In terms of our partnerships in carrying out the SDGs, and the role that we play in spearheading the implementation of the SDGs worldwide, we co-chair with Canada, the Group of Friends for Financing. We co-chair with Belgium, the Group of Friends of Decent Work for Sustainable Development. We are the co-chair for Group of Friends of Children and the SDGs, member of the Groups of Friends for Ocean and Seas Sports for Development and Peace, co-lead with France and Qatar in an initiative to accelerate climate finance investments. And of course, we are very invested in climate change and improving the situation where climate change is concerned. And we have put a lot of human resources as well as financial resources into that because of how vulnerable we are in this region. And our main industries, agriculture as well as tourism, depend heavily on a favorable situation where climate change is concerned. Next slide, please. In terms of financing the SDGs, in keeping with the Addis Ababa Action Agenda for financing the 2030 Agenda, the financing and development framework includes both external and domestic financing. Most of our external financing are from ODAs. Currently, through the ODAs, most of the external financing is provided through the ODAs, multilateral institutions, and bilateral agreements, which are typically used for investment purposes. Next slide, please. So the presentation examines Jamaica's implementation of the SDGs and highlights the role of taxation in financing the SDGs. And the presentation is divided into 4 parts. And next, go on to the road to adoption of Vision 2030 and the SDGs, including the developmental context, the roadmap itself, which was passed in 2017, which details how we intend to get there. And we will identify some of the gaps that have been identified in the roadmap, the role of taxation, and finally, my recommendations on taxation and the role that taxation should play. Next slide, please. In terms of Jamaica's developmental context, we are the 3rd largest island in the Caribbean and largest among the Anglophone Caribbean countries at 4,243 square miles. Our official language is English, and we are divided into 14 parishes, and we have enjoyed a stable democracy since independence from Britain in 1962. We were previously colonized by the Spanish. Next slide, please. We have 2 major airports, and we are home to the 7th largest natural harbor in the world. In terms of the economic factors, our principal drivers are tourism, manufacturing, agribusiness, business processing, outsourcing, bauxite, and alumina. We have low annual growth rate for the past 20 years. In the last 2 or so, barring COVID, before COVID, we had started to see growth of about 1.3 to 2%. And there has been gradual improvement, I would say, over the past 6 years, but there's weak domestic consumption. Our foreign direct investment has been steadily improving in spite of strong regional competition. We are in a region where the economic model for many of our sister Caribbean states is very different from Jamaica. A lot of our Caribbean neighbors depend heavily on financial services. Jamaica, however, does not have that industry. And so in terms of courting foreign direct investment, we do face a lot of competition there. We are predominantly a service economy moving away from an agricultural economy. We have a large informal economy, which comprises about 40% of Jamaica's economy. Our unemployment rate is now at 8.9%, and we have very high migration among our skilled persons and university graduates. I should also say that as compared to developed countries, where on average 8 out of 10% may go on to tertiary education, our recent statistics in Jamaica is that it's about 2 out of every 10 who go on to university education. And so as I speak, I'm sure that you can see some of the developmental challenges that we have and why the attainment of the goals is so important to us. Next slide, please. We have a very high level of remittances because we have a very large diaspora complement, particularly in the United States. And many of our people depend on these remittances, which interestingly enough, during 2020 increased. We were very surprised about that. But a lot of Jamaicans, especially among our lower income, depend on these remittances in order to survive. We have a worldwide tax system with 7 major tax types, the main ones, of course, being income tax, as well as the general consumption tax. The income tax threshold for individuals is 1.5 million Jamaican dollars. And if you want to know what that translates to in US, you can divide it by 150 to 1, which is where the our currency now is. We have income taxes at 25%, and that is between 1.5 to 6 million. If it's over 6 million, then it becomes 30%. Our corporate tax rates are 25% generally, and 33 1/3 for regulated companies. And our tax revenues, inclusive of customs, form 25% of GDP. Next slide, please. Our poverty rate in terms of the social factors, our poverty rate is at 17%. Education, 93% of the children have access to secondary and primary education. However, attendance is sometimes limited because of economic status. University education is typically accessed by women and outnumber the men at a ratio of 70 to 30%. Next slide, please. In terms of our environmental, in terms of our health care, we have a universal healthcare system, but it tends to be very under-resourced. And that, of course, is due to the very small fiscal space within Jamaica is operating in terms of fulfilling the SDGs and meeting some of really what are our needs to remain viable, much more sustainable. The main causes of our health problems are non-communicable diseases such as diabetes, high blood pressure, heart and kidney issues. We do support the health system by funding from the general consumption tax that we collect from tobacco and alcohol, but it is, of course, woefully inadequate. Next slide, please. In terms of our environmental factors, we have a wide range of microclimates, several endemic species of plants and birds. There's a very diverse marine environment. Our main source of water for Kingston and Montego Bay, which is the tourist capital of Jamaica, comes from the Blue Mountains and the Cockpit Country, which is our forest reserve. And of course, I think everyone here may be aware that Jamaica is a major tourism destinations spot, primarily from the United States and Canada, because of its scenic beauty and what so far we have been able to maintain as good coastal quality. Next slide, please. Now, I now go on to the road to the adoption of Vision 2030 and the SDGs. So having given what our developmental context is and trying to highlight what some of our sustainable concerns are, I will now go on to what the path that we have taken in terms of implementing the SDGs, and how we have approached the economic conditions that we have faced and the measures that we have taken to deal with those economic measures, which have helped so far in implementation of the SDGs. So the financial crash of 2008 was one of the catalysts for the Vision 2030. And as I said before, we started from as far back as 2009, recognizing that we had to put a plan in place for sustainability. And that the impetus for that was the financial crash of 2008. We went into a full-scale recession in Jamaica. And we went into that recession with a very weak economy. The country was already burdened by debt and poverty. The GDP, debt to GDP was 127%, and we had not seen any growth for over 20 years. And so that was the background against which Vision 2030 came into being in 2009, 2010, and as I mentioned before, was underpinned by the National Development Plan. Next slide, please. The National Development Plan had four broad, what were called synergistic and independent social, economic, and environmental development goals. And these four broad goals were Jamaica are empowered to achieve their fullest potential. Next slide, please. Jamaica society to be secure, cohesive, and just. Jamaica's economy to be prosperous, and Jamaica to have a healthy and natural environment. And so these four goals were later broken out into 15 national outcomes and indicators. Next slide, please. And what I'm attempting to do here is a chronology to 2017 and where we are now. So that was the situation in 2008 when we experienced the crash. In 2010, the debt to GDP ratio continued to climb. And so the government turned to a debt exchange within the country. And that was able to take us through for a short while. In 2011, because of the deepening economic crisis, we attempted to enter an IMF extended fund facility agreement. However, that ended in failure. The other change in that year was a change in government. By 2012, the debt had risen to 147%. We faced an economic meltdown and had no or limited access to capital markets. We then turned again to the IMF in 2013. Next slide, please. The IMF agreement was characterized by radical tax reform, which included a repeal of the sector-specific tax incentives. We had about 19 tax incentives for any from tourism to cinema to bauxite to most of the productive sectors were experiencing tax incentives. But for over 40 years, none of those tax incentives had brought about the kind of stimulation and economic growth that they were intended to bring about. And so when we entered into the IMF agreement in 2013, a decision was taken to repeal the sector-specific tax incentives. We instead introduced an employment tax credit into the Income Tax Act. And so the focus became not just employment, but also compliance. And so the employment tax credit, what it does is the tax rate being at 25%, the employment tax credit will, once the employer has filed the tax returns and has accounted for the payroll deductions, your tax credit can be reduced to as much as 17.5%. So there is a 7% tax credit that is given, but there are conditions. You must be compliant. We had a very, very low compliance rate prior to this happening. The Customs Act was also revised to allow production input stimulation for key sectors such as tourism, manufacturing, and the creative industries, as well as health. Next slide, please. We established Tax Administration Jamaica was a part of the Ministry of Finance as a department within the Ministry of Finance, and therefore attached to the civil service. Tax Administration was established as a statutory body and vested with the power to retain staff that that had high capacity and were experts in taxation. We also streamlined the charities, the approach to the taxation of charities, which had enjoyed very wide exemptions across all the tax types, but were treated differently by each tax law and had become a main source of tax expenditure. And so that was streamlined. The power of the Commissioner General of TAJ was expanded to access information. There was greater data mining capacity, and we also introduced transfer pricing legislation in 2015. Prior to that, transfer pricing was in the anti-avoidance provision of our Income Tax Act. However, it was just simply a statement saying that the arm's length principle should be observed, but there was no guidance that was given either to the tax administration or the taxpayer as to what the arm's length principle really was. And so we introduced with assistance from the OECD, a very defined transfer pricing framework in the Income Tax Act. Next slide, please. I don't know how I'm doing for time, but so let me kind of.
You have approximately 7 minutes.
Oh, okay. All right. So as a result of the IMF agreement, we were able to get our fiscal and external sustainability restored. There was a reduction of unemployment and gradual growth. Next slide, please. Rise in capital and social spending and a reform in the financial sector, and the central bank has been now made autonomous. Next slide, please. Now, the reason why I highlighted the IMF agreement is because it laid the groundwork for the achievement of goal 8, which is a stable economy, as well as it turned out to be a very productive partnership between Jamaica as well as the IMF, as well as our major stakeholder in Jamaica, which was the private sector, which actually kept the government accountable during this time of the IMF agreement. And it was the first time that we were having that kind of cohesion between government, private sector, and of course, with the assistance of the technical work of and the extended fund facility of the IMF. Next slide, please. Okay, I think I will just skip this since I just have 7 minutes and just go perhaps to the so Frederick, if you could just go down to perhaps slide 30 to the roadmap. I'll just make a few comments on the roadmap, which was introduced with the assistance of the UNDP. And what we at that point did now was to align the Vision 2030 and the national outcomes with the SDGs. And the roadmap does identify where there are some gaps between what we had as Vision 2030 and the SDGs. And they have made recommendations to ensure that those gaps are filled, because the gaps that there are major gaps and will have a negative impact on sustainability if those gaps are not filled. And I'll give you an example. One of the gaps that they have found is that we don't have any matching target within Vision 2030 for issues such as how to deal with some of our environmental issues. There is no defined and specific policy to deal with the issue of energy and dealing with non-fossil fuel. And so these are some of the gaps that they have identified and recommendations have been made. And so I will just go on to the taxation, to the role of taxation. Now, the roadmap has identified that these are the following areas of financing the goals: taxation, green fees, development finance assessments, debt for nature swaps, and the blue economy investments. So they have given no specifics, but these are the areas that they have identified for financing of the goals. And what we found as well is that the roadmap itself is very scanty on a discussion on financing the goals. There are ideas, there are concepts, but they don't go into detail. Taxation, as far as the the roadmap is concerned, there is very little that is said about taxation. In fact, only transfer pricing is mentioned. And Frederick is trying to keep up with me. I am at slide. Could you go to the next slide? The next slide. Right. So while there is a recognition that taxation generates the funds needed to finance the delivery of goods and services by the state, that it will significantly impact economic growth and be used to target certain types of consumption, the report, next slide, please. Next one, the next slide, right. The report, while acknowledging that there's limited fiscal space, mentions only transfer pricing as a specific tax measure. And the inference, therefore, is that where multinationals are, as well as local corporations, where they carry out intragroup transactions at arm's length, then this will assist in creating the much needed and elusive fiscal space to enable the relevant SDGs. However, next slide, please. There are some issues there. Jamaica introduced transfer pricing in 2015, much along the OECD guidelines, and the rules were amended in accordance with the OECD rules. We also had a 3-year capacity development program. We have had TIW expertise. Next slide, please. However, to date, Jamaica has concluded few transfer pricing audits. There has been no take-up of the advanced pricing arrangements, and even the audits that we have done, what we have found is that most of the audits are under objection. And so we have a dispute resolution issue internally dealing with in respect of some of these audits. Next slide, please. And so in terms of my recommendations, I believe that we should have in Jamaica a separate roadmap which focuses on financing the sustainable development goals, and they should focus on financing the sustainable development goals. There should be, in terms of the governance structure, the Ministry of Finance and the TAJ should be added to the list of governmental authorities which are now steering the SDG implementation. There should be a working group convened by the Ministry of Finance to include corporate Jamaica. Next slide, please. We should have a development of a corporate responsibility framework to address specific targets of financing the goals, decent work, capacity building of lower level staff. So what tends to happen is that a lot of our people, the education system, a lot of them leave the education system without qualifications, but they get work, they get low income work within these corporations. We believe that it should be a vested right of an employee of the lower level, in the same way that they train their managers, the lower level persons who come in without any qualifications. It should be a right of that employee to be trained as well. So you meet the employee wherever he is and ensure that training is done at the cost of the organization. So that is another way of building capacity. We believe that our tax policy should be more data-driven, should be more targeted, and we must recognize that taxation as financing the sustainable development goals will not be able to meet all the concerns. We have a very low, we have a large informal economy, we have low consumption, we have a small tax base. And so what can the taxation system do? Next slide, please. I believe that we should limit whatever we can get out of the tax system. We should limit that to financing health and education. I think if we are able to finance health and education, then we will deal with a number of the goals. And so therefore, I think that whatever the tax system, the role that taxation is to play in the SDGs should be limited, and there should be no attempt to expand it, because at the same time, there are other needs that, that taxation will need to cover. We should provide for a more streamlined use of dispute resolution. We should have a defined international tax policy, a recognition that the BEPS issues will not address all of our problems. BEPS base erosion, I think, is estimated at dealing with 3% of the SDGs, what you can actually get out of BEPS. And so therefore we have to recognize that limitation. In terms of the the global tax landscape, we have to look again at the transfer pricing legislation that we have introduced to see whether or not it is fit for purpose, or we should be using a formulary apportionment system in terms of dealing with transfer pricing. We have to look at our withholding tax rates as well, and the whole issue of withholding by source countries, as you know, is a thorny issue which came up, next slide please, which came up in the digitalization of the economy. And so that is an unresolved issue within the global tax system. I want to speak just briefly about the consensus in July of this year, which was signed on to by now 133 countries. We signed on to it as well. We also made our comments and articulated our concerns about that. We believe that consensus to sign the agreement is an agreement to cooperate, not necessarily a commitment to implement. And so therefore we await the outcome in October to see how the other outstanding issues are addressed and to see whether or not there will be consensus. But we have signed on to it, and we are very invested in the multilateral solution to digitalization of the economy. The last thing I will mention is our is tied to goal 17, which is partnerships, and that is that we believe as well that Jamaica would benefit greatly from assistance if there is cohesion in the CARICOM region around the development of the SDGs and the implementation of the SDGs. And therefore, we look forward to playing our part, as we have been doing, in bringing the region together around the common interests. So that's the presentation.
Thank you so much, dear Marlene, and thank you for giving us this perspective from a developing country. What I think is important, and that's the reason why you started also with what type of country is Jamaica, what Jamaica needs, what is the development of Jamaica, but also seeing with the roadmap to sustainable development. One of the problems that you have is that when we look at, for instance, the country-by-country reporting, and in your view, the country-by-country reporting says there are not yet legislation, but you can talk a little about that. Mm-hmm. Then you need to take a step back. And this step back means to look what the country, in this case Jamaica, has, that is also a concern of developing countries. Mm-hmm. So it's not only, for instance, the issue of the informal economy, for instance, the issue of tax incentives, for instance, the issue of resources. And this is important because even though we are talking about transparency and sustainability and reporting, sometimes it doesn't really match all the needs between the two, the developed and developing countries. So in that case, you foresee that, for instance, the country-by-country reporting, and this is a very provocative question, mm-hmm. Do you foresee that the country-by-country reporting will be able to give you information, for instance, since one of the problems that you have is transfer pricing and the comparables, it will be something that it will give you more information, or you say, actually, this doesn't really help me?
Mm-hmm. I think, let me just make a general comment about reporting overall, right? Because what we have found is that since enhancing our ability to get data has improved compliance overall. When we introduced transfer pricing legislation, our business community we had more filings, we had more compliance as a result of introducing transfer pricing. And so I think that if we are able to introduce the country-by-country reports, with the legislation, by the way, is going through the passage process at the moment, the legislative process at the moment. And so a bill has been drafted, and it is going through the usual stages towards introduction, we hope by the end of this year. Now, because CPC reporting is used for risk assessment, I believe that that would be very, very helpful, because we have, although we don't have any companies at the 750 million threshold, we do have a number of subsidiaries and other connected parties to the ultimate parent entities. And so therefore, we believe that it would be very helpful in assisting us in terms of risk assessment and identifying, where the issues are that we need to target.
Thank you so much. I give the word to Frederick, and please, Frederick, go ahead.
Yeah, thanks. One quick question would be, you mentioned that transfer pricing was identified, I think it was a UNDP report, as you said the only issue to raise revenue. I was wondering whether you know how this came about. Was there a study before into where, let's say, Jamaica has revenue losses or revenue potentials, or was this more kind of a generic basic recommendation that came from somewhere?
It came from the fact that our audits were showing that, particularly in the region, which is where we do face a lot of our base erosion issues in the Caribbean region, that we were having a lot of profit shifting being done in relation to management fees, royalties, headquarters services, and so on. And because a lot of the headquarters are in the financial centers, and so that is what the audits were showing. And that is what brought about the impetus for the introduction of transfer pricing before. And so base erosion, we have realized, is a major contributor to revenue loss in Jamaica. And so transfer pricing was suggested as a means of cauterizing the revenue loss. Of course, tied to that, of course, is the issue of the CARICOM DTA, which is a multilateral instrument and which cannot be amended unless you have the agreement of all 11 signatories. And so that, as you may realize, would be a very sensitive issue, and there are attempts to address that particular issue. Not sure how Pillar 2 will play out in terms of the minimum tax and the subject to tax rule in particular in that case, but we imagine that it will be on the agenda of CARICOM nations to discuss.
Let me give the word to Willem Jan, because from his experience also working with developing countries regarding the country-by-country report, and perhaps you can guide us a little.
Yeah, well, thank you for that, Irma. Well, I was also curious to hear from Marlene. You see the added value of country-by-country reporting, but I think it would be beneficial for transfer pricing risk perspective. Also, if you have a related party dealing schedule, so also if you have individual transactions which you can compare, for instance, is that something Jamaica has, or?
Let me just make sure I'm understanding what you're saying, Willem. You mean if we have compared? Are you talking about the comparable data issue, or is that what you're?
No, sorry. Let me explain a little bit better.
Yeah, okay.
I'm referring to, we have, as part of the OECD BEPS action item 13, we have the master file, the local file, and the CPC report.
Oh, okay.
But prior to that, many countries already had some form of TP risk assessment based on information as part of the corporate income tax return. And the reason why I ask is because CBC data is really interesting to get a holistic view of the company. But when you are doing risk assessment, individual transactions offer much more information than CBC reports.
Well, let me tell you, it wasn't until 2015 when we introduced transfer pricing that we introduced a schedule that corporations have to complete and to list their intra-group transactions. So prior to that, there was no request. It was just the usual return that they would file and they were expected to list all their transactions, including intragroup transactions, but there was nothing that was specific, and there was no consequence for not listing those transactions. Now, if you do not complete what we call the Schedule 8, and if you do not complete it accurately, there is a penalty of $2 million. And so since that time, we have had almost full compliance with the completion of the Schedule 8.
Okay, because that's really helpful. But this is also sharing a little bit of my experience, because in the Netherlands we are thinking of introducing such a schedule. And during that investigation, I also talked to a lot of other countries. And one of the things many countries are struggling with is, how do you incorporate the functionality within such a related party dealing schedule? Is that something you are also struggling with?
Yes, we are struggling. We are struggling with that. Yes, we are struggling with that issue as well.
Because it's not too difficult to list all the transactions, and you would see which kind of transfer pricing method is used and what the amount is, etc. But that doesn't tell you the whole story, because you would still need information to look at where the functions are performed, where the risks are located, etc. And I've seen many related party dealing schedules, and that's something a lot of countries are struggling with as well.
Yes, and in fact, we are in the process of amending. We are going to be amending the transfer pricing legislation because there are some provisions of it that we found were not really suitable for Jamaica. I think we have as mandatory, I think our methodology that we recommend in the Act, I think is the COP, right? The comparative, right? But that may not, we have realized that given the architecture of the Jamaican economy, and the type of multinational involvement that we have, that may not be the best methodology to use. And so we are looking at the methodologies themselves as well. We'll always have the issue of comparable data. That's always going to be a problem. But the thing with the transfer pricing legislation is that it not only targets cross-border transactions, but it also targets domestic transactions where there are groups. Okay, so right. So that we can look at the intra-group flow within the country. So it doesn't necessarily have to be a cross-border transaction that is taking place. Most of our transfer pricing issues would arise with the hotels, for example, because we have a hotel chain that a local hotel chain which operates across the region, but most of our local hotels are owned by foreigners, particularly Europeans, and so therefore we have that issue. The BPO industry that I spoke about a while ago, which is one of our largest employers, they too are headquartered elsewhere. And so we do have quite a lot of transfer pricing, issues that we have to look at.
Yeah.
Thank you.
Thank you so much. Let me give, because we are now talking about transfer pricing, and Cassandra has a question. Cassandra, please go ahead.
Sorry, thank you very much for this lovely presentation. I first wanted to jump in on what you were saying about the domestic transfer pricing cases, because I also came across this in Uganda, and at that time I was not familiar with it. And one of the things that I heard afterwards is that it's a consequence of not having consolidated tax filings. I don't know if I'm using all the correct terms, but that companies don't have to consolidate their activities of all the different entities. I was just asking to confirm, and if it's not, maybe something that's a lot of energy goes in, while it can be quickly circumvented by asking consolidated numbers.
Yeah, we are just now introducing that requirement. That's also an issue that we had.
Okay, thank you. And then I had another question, just from your experience. So one of the comments was that there is a difficulty of establishing the functionality or the reality of certain costs that are being deducted, such as management fees and so on.
Right.
Do you ever consider, or the whole government, to adopt safe harbors or having certain fixed margins?
Yes, we are looking at that as well. We are actually undergoing a complete overhaul of our Income Tax Act, and those are some of the issues that we are looking at introducing.
Okay, thank you very much. Yes, I've been studying 3 East African countries and their introduction to transfer pricing regulations and audits. And I think, well, Rwanda has very recent transfer pricing guidelines. And so I was wondering if there would be some comparisons there, but thank you.
Okay.
Now, thank you so much, everyone. As you see, we started with transparency. We started with country by country reporting. We talk about the elephant in the room, and that is transfer pricing, especially for developing countries. This is a problem. And it always be like that. And that's also very nice to see that these kind of seminars online also allow to, for instance, people who are working in Africa, working in Latin America, working in Europe. And we also have some people here from Asia, I believe. So thank you so much. This is the first session. We are a little early, but that's also good because this is it's a long day. So we will start at 3:55. And in the chat, you have a new Zoom link because for each session, we have a new link. So please make sure that you copy and paste. And at 3:55, you will have the second panel, the second session where Professor Thomas Bernard and Florian Regley will be leading that panel. And this is from my side, but of course I will see you in the second session. Thank you everyone, to all the speakers, to all the people who have presented, but also giving their comments and questions. Hopefully this is useful for everyone. And please feel free to also keep in the chat the discussion also with the other sessions, and let's continue this discussion. We see each other at 3:55. Thomas, would you like to say something or?
No, thank you very much. You already said everything. There is a new Zoom ID, and the ID number is also in the chat, and we will meet 5 minutes to 4 o'clock with our next session. Thank you very much, Emma. You did a great job. Thank you.
Thank you so much, and thank you everyone, the speakers and the people who presented and attended, and I see you at 3:55 Dutch time.
Goodbye, thank you.
Bye.